You finally have $10,000 sitting in your account, and now comes the part nobody prepares you for. Where do you actually put it? One stock? An index fund? A few different companies? Maybe you wait for the market to drop. And suddenly having $10,000 feels less like an opportunity and more like a decision you can't afford to get wrong. Picture handing that exact $10,000 to Warren Buffett and saying, "You have to build the portfolio yourself. It's 2026, what do you buy?" The interesting part isn't which stocks he would choose, it's what he would refuse to buy, and the reasoning behind every dollar he puts to work. Because if there's one thing Buffett's career has shown, it's that knowing what to ignore can be just as valuable. Chapter 1. What Buffett would probably refuse to buy. Let's start with the part most people would probably get wrong. If you gave Warren Buffett $10,000 today and asked him to build a portfolio, he probably wouldn't start by asking, "What's going up the most?" He'd start by asking a much less exciting question, "What can I understand?" That distinction matters, because when you have $10,000 sitting in cash, the internet gives you thousands of possibilities. AI stocks, crypto, dividend stocks, the latest company everyone on social media is talking about, and every one of them comes with a story. That's the problem. A good story isn't necessarily a good investment. Buffett has spent decades warning investors about the danger of investing in businesses they don't understand, and there's a reason for that. When you don't understand how a company makes money, you can't properly judge what it's worth. You can't easily tell whether its competitive advantage is durable. And when the stock eventually falls 30 or 40%, you don't know whether you're looking at an opportunity or a warning. That's when emotions take over. You start watching the stock price instead of the business. You check your phone. You look at what everyone else is doing. And eventually, the original investment thesis disappears. You're no longer investing, you're reacting. Buffett's approach is almost the opposite. He has repeatedly emphasized staying within a circle of competence, an area where you can understand the economics of the business and make a reasonable judgment about its future. That doesn't mean you have to understand everything. It means you have to know what you don't understand, and that's a surprisingly powerful skill. Say someone offered you a stock that could potentially double in a year. Sounds exciting, but then they tell you the business model is complicated. The future depends on assumptions you can't evaluate, and nobody really knows what the company will look like 5 years from now. Would you still buy it? A Buffett-style investor might simply say, "I don't know," and walk away. That's not weakness, that's discipline. In investing, saying, "I don't know," can protect you from losing money you never needed to risk. This is especially important with a relatively small portfolio. If you have $10,000, a major mistake isn't just a temporary setback, it can erase years of progress. Lose 50% and you're down to $5,000. To get back to $10,000, you don't need a 50% gain, you need a 100% gain. That's why Buffett's famous emphasis on avoiding permanent loss matters so much for someone starting with limited capital. The goal isn't to turn $10,000 into $20,000 as quickly as possible. The goal is to build a portfolio that gives your capital a reasonable chance to compound for many years. And that immediately eliminates one of the biggest mistakes beginners make, confusing excitement with opportunity. A stock can be exciting, a technology can change the world, and the investment can still be terrible if the price you're paying leaves you with no margin for error. That's the part that gets lost when people ask, "What would Buffett buy?" Because Buffett isn't simply looking for great companies. He's looking for a combination of quality, understandable economics, durability, and a sensible price. And once you understand that, the $10,000 portfolio starts looking very different. Because now the question isn't, what are the 10 best stocks in 2026? It's, what deserves a place in this portfolio at all? And that brings us to the first real decision Buffett would have to make before buying a single stock. Chapter 2. The first question isn't which stock to buy. Before Buffett decided where to invest the $10,000, he'd have to answer a more basic question. Should all $10,000 actually be invested? That sounds obvious, but it's one of the most important questions a new investor can ask. Because investing money you might need next month is completely different from investing money you can leave alone for 10 years. Say you've got $10,000 in your bank account. You invest the entire amount. 6 months later, your car breaks down, or you lose your job. Suddenly, that investment isn't long-term money anymore. You need the cash. And if the market happens to be down 20% when you need it, you may be forced to sell at exactly the wrong time. That's not a failure of the marketplace. It's a failure of matching the investment to the time horizon. And this is where a Buffett-style mindset becomes useful. Buffett has repeatedly emphasized the importance of having enough liquidity and avoiding situations where you are forced to sell good assets at bad times. So, if we're building a hypothetical $10,000 portfolio based on Buffett's documented principles, we shouldn't automatically assume that all $10,000 belongs in stocks. First, we'd separate financial security from long-term investment. If the $10,000 represents someone's entire emergency savings, putting all of it into stocks would be a very different decision than investing $10,000 they genuinely won't need for years. That distinction changes everything, because once your short-term financial needs are covered, you can think differently about market volatility. A 20% decline stops being an emergency. It becomes something you can potentially sit through. And that matters because Buffett's philosophy depends heavily on patience. You can't be patient with an investment if you're worried about needing the money next week. This is one reason investing isn't just about picking assets. It's about building a financial structure that allows you to stay invested. Think about it this way. A great investment strategy that forces you to sell at the worst possible moment isn't actually a great strategy for your situation. The best portfolio is one you can emotionally and financially hold through difficult periods. That's why the first question isn't which stock to buy, it's can I afford to leave this money alone? If the answer is no, the portfolio may need to start somewhere other than the stock market. But let's assume the $10,000 is genuinely long-term capital. No high-interest debt that needs immediate attention, an appropriate emergency reserve is already in place, and the money can stay invested for years. Now, the interesting part begins, because Buffett has another problem. There are thousands of publicly traded companies. He can't own all of them, and with only $10,000, he doesn't need to. In fact, owning too many companies can create another problem. You may end up owning businesses you never really studied. You might think you're diversified when you're actually just spreading your uncertainty across dozens of stocks. Buffett has often argued that investors who truly understand what they're doing don't necessarily need to own a huge number of companies. But that doesn't mean everyone should build a 5-stock portfolio. For most ordinary investors, broad diversification can reduce company-specific risk and is often much easier to maintain. That's an important distinction. Buffett's personal investing style isn't automatically the correct portfolio construction for every individual investor. We're not trying to copy his portfolio, we're trying to understand his decision-making process. And that process starts with one simple principle. Don't put money at risk just because you have money available. Put money at risk when you have a reason, a time horizon, and a level of risk you can actually live with. Now, assuming our hypothetical investor has cleared that first hurdle, we finally get to the question everyone came for. What would Buffett actually want to own with that $10,000? And the answer starts with a type of business he spent his entire career searching for.
Chapter 3. The kind of business Buffett would want to own. Now assume the $10,000 is truly long-term money. You don't need it next month, you are trying to double it by next year, and you're willing to watch the market fall without immediately selling. Now Buffett can finally ask the question he cares about most. What kind of business deserves my money? And his answer isn't simply a company with a great stock. Because Buffett doesn't really think of himself as buying stocks. He thinks of himself as buying pieces of businesses. That sounds like a small difference. It's not. When you buy a stock because you think its price will rise, you're focused on the market. When you buy a business, you're focused on the economics behind that price. How does it make money? How predictable are those profits? How much capital does a business need to keep growing? Does it have an advantage competitors can't easily destroy? And, perhaps most importantly, what could this business look like 10 years from now? That's the kind of thinking Buffett has used throughout his career, and it gives us a useful filter for our hypothetical $10,000 portfolio. First, we want businesses that are understandable, not necessarily simple, understandable. There's a difference. A company can operate in a complicated industry and still have a business model you can explain clearly. If you can't explain how the company makes money, why customers keep coming back, and what could cause that advantage to disappear, you probably shouldn't be putting your hard-earned money into it just because the stock is popular. Second, Buffett looks for businesses with durable competitive advantages. He often describes these advantages as an economic moat. Think about an actual castle. A castle with no moat is much easier to attack. A business without a durable advantage is similar. If competitors can easily copy its product, undercut its prices, or steal its customers, then today's success might not mean much 10 years from now. But some companies have characteristics that make competition much harder. Strong brands, network effects, switching costs, distribution advantages. None of these guarantee success, but they can make a business more difficult to disrupt. And that's exactly what a long-term investor wants. Something that can keep producing value after the excitement surrounding the stock disappears. Third, Buffett cares about the quality of the economics. A company can grow revenue rapidly and still destroy shareholder value. Growth by itself isn't enough. What matters is what the business earns from the capital it needs to operate. That's why investors often look at measures such as return on equity, return on invested capital, operating margins, free cash flow, and balance sheet strength. The exact metric matters less than the underlying question. Does this business consistently turn capital into more capital? Because that's what creates long-term compounding. And then comes the part that trips up even experienced investors: price. A wonderful business can still be a bad investment if you pay an unreasonable price. Picture finding an incredible hardware store, loyal customers, a strong local reputation, well run for decades. You'd probably agree it's a great business. But what if someone asked you to pay $100 million for it? Suddenly, the quality of the store isn't the only question. The price matters. Investing works the same way. Buffett has spent decades emphasizing that the price you pay matters enormously to the return you ultimately earn. That's why simply searching for the best companies isn't enough. We're looking for a business that's good enough, durable enough, and attractively valued enough to justify putting our limited capital behind it. And this is where our hypothetical $10,000 portfolio becomes interesting, because we now have a framework. We're not looking for the stock that's trending on social media. We're not trying to predict next month's winner. We're looking for businesses that can potentially remain economically strong for years, and we're trying not to overpay for them. But there's still a problem. Even after filtering thousands of companies through those criteria, we could end up with a portfolio that's incredibly concentrated. And that's where Buffett's personal approach and the average investor's situation begin to diverge. Because if you only have $10,000, how much should actually go into individual businesses? How much should go into an index? And should you even try to pick stocks at all? That's the decision that determines what this hypothetical Buffett portfolio could actually look like. Chapter 4. If Buffett had only $10,000. Now we have the framework. We know what Buffett would probably avoid, we know why the money needs to be truly long-term, and we know what characteristics he'd look for in a business. But there's still one question left. How would you actually divide the $10,000? And this is where copying Buffett becomes dangerous. Because Buffett is an exceptional investor with an enormous amount of capital, experience, access to information, and the ability to tolerate concentrated positions. Most people aren't. So rather than pretending Buffett would hand us a precise 2026 allocation, let's build a hypothetical portfolio based on the principles he has publicly discussed. And let's start with the part Buffett himself has repeatedly recommended for ordinary investors: the S&P 500. Buffett has publicly said that for many people, a low-cost S&P 500 index fund can make more sense than trying to pick individual stocks. Why? Because owning an index gives you exposure to hundreds of large U.S. companies without requiring you to correctly identify which individual company will win. So say we put $7,000 of our $10,000 into a low-cost S&P 500 index fund. That's 70% of the portfolio. You're not trying to predict which company will dominate the next decade. You're simply owning a broad collection of leading U.S. businesses and allowing the overall economy to work for you. Then we'd have $3,000 left. This is where we could introduce a small individual stock allocation. But there's an important rule. This isn't money for speculation. It's money for learning how to analyze businesses. Suppose we divide that $3,000 across 3 companies at $1,000 each. Now the investor has a reason to study individual businesses without making the entire financial future dependent on getting 3 stock picks exactly right. That distinction matters. If one company disappoints, the majority of the portfolio is still diversified through the index. And if one of the individual companies performs exceptionally well, you've gained experience understanding what made that business successful. But there's another option. And for a truly Buffett-inspired approach, it may actually be the more interesting one. Put the entire $10,000 into a low-cost, broad-market index fund. No stock picking, no constant monitoring, no trying to predict next Apple. Just own the market and leave it alone. That sounds almost too simple, and that's precisely why many people won't do it. Investors often confuse complexity with sophistication. A portfolio containing 15 stocks, 3 ETFs, options, crypto, and 5 different sectors can look impressive. But if you don't understand why you own each position, it's not necessarily sophisticated. It may simply be complicated. And Buffett has repeatedly argued that most investors would be better served by a low-cost index approach than by trying to outperform the market themselves. So which approach is actually better? It depends on the investor. If you don't have the time, knowledge, or interest to analyze businesses, the broad index approach is arguably the more rational choice. If you genuinely enjoy studying companies and can tolerate the additional risk of individual stock selection, a smaller allocation to carefully researched businesses can make sense. But there's one thing we should never do. Pretend that a hypothetical portfolio is a guaranteed recipe for success. It isn't. The S&P 500 can fall sharply. Individual companies can permanently lose value. And a portfolio that looks reasonable today can look very different after a decade. That's why the real lesson isn't the exact percentages. The real lesson is the hierarchy. First, protect money you may need soon. Second, build a diversified foundation. Third, only take concentrated risks when you genuinely understand what you're buying. And finally, give the portfolio enough time to work. Because if you invest $10,000 and then constantly change the portfolio every time the market gets scary, the allocation almost doesn't matter. Your behavior becomes the biggest risk. And that's where Buffett's philosophy becomes much more interesting. Because his greatest advantage wasn't simply knowing which businesses to buy. It was his ability to sit still while everyone else was reacting. And that may be the hardest part of this entire $10,000 portfolio. Final chapter. The hardest part is doing nothing. So the $10,000 is invested. The portfolio is built. The investments are selected. And then the market drops. Not 5%, not 10%. Let's say your $10,000 portfolio suddenly becomes $8,000. What do? That's the moment when the portfolio you built on paper becomes a real test of your psychology. Because when prices are rising, almost everyone feels like a genius. When your account is up 20%, investing feels easy. You check the app, you feel confident, you start thinking maybe you should have invested even more. Then the market falls, and suddenly every decision feels questionable. Maybe you picked the wrong fund. Maybe this time really is different. This is where Buffett's philosophy becomes extremely difficult to follow. Because Buffett isn't trying to predict every short-term movement. He's trying to own assets that he believes are worth more over the long run than what he bought them for. That's a completely different game. In his 2016 Berkshire Hathaway shareholder letter, Buffett described the ideal holding period for a wonderful business as forever.
That statement is famous, but what people often miss is the discipline required to actually live by it. Because holding a business forever means watching its stock price rise and fall for decades without intervening every time the market gets nervous. It means resisting the urge to lock in small gains simply because a stock went up 20%. And it means refusing to panic sell when a great company experiences a temporary setback. That's why the hardest part of managing a $10,000 portfolio isn't deciding which assets to buy. The hardest part is leaving them alone. Think about how modern financial apps are designed. They send notifications every time a stock moves. They display bright green and red colors to draw your attention. They encourage frequent trading, constant monitoring, and immediate action. Everything about modern financial technology is designed to make you do something. Buffett built one of the greatest investment records in history by doing the exact opposite. He reads annual reports, he studies businesses, he calculates intrinsic value, and then, once he makes a decision, he gives that decision time to work. If you put $10,000 into a well-chosen portfolio and then constantly buy, sell, reallocate, and react to every market headline, you aren't following Warren Buffett's approach. You're speculating. So if you had $10,000 to invest today, what would Warren Buffett actually tell you to do? He probably wouldn't give you a list of hot stocks, he wouldn't promise fast returns, and he certainly wouldn't tell you to check your portfolio every morning. He'd tell you to ensure the money is truly long-term. He'd tell you to put the vast majority of it into a low-cost, broad market index fund like the S&P 500. He'd tell you to keep a small portion in cash or cash equivalents for flexibility. And if you insist on buying individual businesses, he'd tell you to focus only on companies you understand, with durable advantages run by competent management, available at a sensible price. Then he'd tell you to go back to your life and let time do the heavy lifting. Because in the end, building wealth isn't about outsmarting the market every single day. It's about building a sensible plan, having the patience to stick with it, and giving compounding the time it needs to turn a modest investment into something extraordinary. That's the real lesson behind a $10,000 Buffett portfolio. It was never about the $10,000. It was always about the discipline to leave it alone.